So ExxonMobil is the world's largest petrochemicals company, and it's involved with exploration, production and retail of crude oil, petroleum products and natural gas.
Right, so this one is headquartered in Irving, Texas, which if you look at the map is kind of in that huge Dallas-Fort Worth conurbation. And I mean, this is the largest player. It's probably the outcome of the US's kind of original oil in the firm of John D. Rockefeller Standard Oil morphed through lots of changes. This is the big boy in the whole industry.
It's the big boy in the industry with a market cap of $342 billion, PE ratio here of 43.9 and a dividend yield of 3.6%. Share price graph will give us some clarity on where we are tracking at the moment.
New York Stock Exchange listed XOM is the code, and you can see it doesn't really present all that much drama over a 5-year chart, but if you have to go back a bit, you'll see that it's done okay. It's done pretty well. Does of course take that slump, as Nick indicated, in 2014, 2015 when the wheels came off the oil price.
So Nick, take it away on ExxonMobil and your thoughts for the future of this company as an investment.
Okay, so just to put it in perspective, it's a big business. I mean, it's the largest company on earth with regards to revenue, 4.4 trillion rand. To put that in perspective, you can buy Anheuser-Busch and sure, quite a lot of other businesses on the South African Stock Exchange and have change left over to buy Sasol. So, you know, these are huge integrated businesses, so it's, excuse the pun, a huge oil tanker to change anything here. So these guys are looking 24 months at time and saying, look, oil's not spiking through the roof in their opinion, so they have to relook at their exploration costs, the capital expenditure, and you've actually noticed that through a lot of the major oil and gas companies. They're cutting back, and they're cutting back massively. I mean, you're looking at $30 billion to $20 billion per year, $10 billion saving. And that's allowing them to get a huge amount of free cash flow through the business. Hence, the dividend yield is actually being pretty good on these guys. So 3.4% is not too bad from a dividend yield perspective. Around about the early $80 level seems to be technically good support. You know, having a look at some commentators and analysts in the States, they would be buying the stock off $80. But from a 5-year investment view, it's flat. You know, you've done really well if you managed to buy at the beginning of 2016 with the oil price recovering. It just shows you direct correlation. So my only concern and my only fear with regards to this is that I don't think the oil price for these companies in the shorter to medium term is going to be a real kicker. Where the kicker is going to come through is how much money are these guys going to save? How clever can they be to actually reduce their costs? Because that's where the oil companies can have an influence. They are price takers. They will take whatever the oil price is, but they can influence how much it costs to produce a barrel
Paul,
of oil.
now the business model really for most of these companies, and perhaps setting the scene for the rest of our discussion, is, as Nicholas says, really cost reduction. Now that's not too exciting from a growth perspective.
That's true, and you know, it's no small feat to replace their current oil production anyway. I mean, they're producing about 4 million barrels a day, which is about 5% of global production. So just to stand still, they've got to do quite a lot of running. They've got production assets all over the world, and they are principally a production company. They're less involved in the retail service station end of the business as they used to be. But, you know, I mean, remember, they've got a couple of cards to play. Their former CEO, Rex Tillerson, is now the Secretary of State under Donald Trump's new administration. That meant, inter alia, as we all know from the scuttlebutt, that got them into Russia, because Rex is on first name terms with Vlad, you know, Putin. And so they've developed assets together over there, and I think they're going to play their cards quite carefully, optimize their portfolio. So I think the yields and the dividend yields will remain positive.
But a flat outlook for a 5-year period, Nicholas, is that correct?
For the past 5 years, your stock has been pretty flat here. So this $82 share price, if you want to get involved at these levels with a PE ratio of about 44, a 3.6% yield, it's not too bad if you understand that the management team is really going to get that free cash flow going across, buying back shares, continuously paying out dividend. You could do well. It's just, in my opinion, not a growth stock unless the oil price shoots up to $90, and then you're singing very, very happily, you know.
Paul?
Hot or not? So I'm going to go not hot on this one, although it's close, and that's because I'm a little bearish about the oil price outlook. Nick, how do you want to call it?
Oh goodness! So at $82 short-term view, I'm hot on the stock actually, but
fine.
From an investment perspective, next 3 to 5 years, I would still be very cool on the stock and not hot currently.
All right, so there we go. We'll allow him with the differentiator between the short and long term. Exactly.